But I don't always tell people, like, sometimes, like, I know that paying taxes is painful. Like, everybody gets surprised. But if you can kind of do check-ins throughout the year and say, okay, where are we at with the realized gains? Where are we at with the income? What does it look like for the rest of the year? They can almost emotionally start to plan for that tax event a little bit better than waiting, like doing what most people do, which is they wait until April if they're filing on time, or May, June, July if they're filing extensions, and then they wake up and they're like, oh my God, the return came.
Hi, Brian.
Hi, Kelly.
What are we talking about today?
We're going to talk about your favorite topic, taxes.
Oh, no. Oh, taxes. That's my favorite topic.
Yeah, don't worry. We won't go into all the things tax related, but we're going to focus on a few things today, particularly for people who might be considering retirement, and what are like some core areas of taxes they need to be thinking about as they head into retirement.
Okay, so let's definitely narrow this down. Let's think of the top 3 things that you should think about for taxes regarding retirement planning.
So first and foremost, how are your income streams going to be taxed? Like if you have a pension, if you have Social Security, things like that, what does that do to your tax return?
Oh, okay.
Okay, because a lot of you might have income sources that you didn't have before. At the same time, that work income that you had might be dying down or leveling off, and you might end up actually in what you think might be a lower tax bracket.
So there's strategies on like how to think about taxes when it comes to kind of your income streams.
That's right. The other is going to be capital gains, especially if people have portfolios they've built up for a long period of time. These are not retirement plan assets. These are after-tax accounts.
So like things like in an individual account, a trust. So tell us more about that. Like what is the capital gains? What do we need to think about there?
So if you're going to start taking money out of the portfolio, like depending on the size of it, like the portfolio might already be creating taxes for you today.
Okay.
And you're okay because you've been paying those out of pocket as you go along.
Yeah.
But if you start needing to take larger chunks for one-off events, you might need to be thinking about what's this going to cost me to do this, or what's the tax implication of doing this. And it's not, a lot of the time I hear people get capital gains tax rates get confused with ordinary income tax rates.
Yep, I think I could see that.
Right, because most people get their tax return and the accountant's like, you owe or you don't owe, and they're happy or they're sad. It's like, that's it.
That's what happens, yeah. Or some people get very mad.
Yeah, or very mad.
Okay, so we talked about income streams, capital gains. Okay, what's the third thing?
Third thing is how does your tax bracket really change in retirement? And I'm gonna poke at that a little bit, because the way saving for retirement used to work, like most of the time you had a 401k or some sort of pre-tax retirement plan that you could put money in from your paycheck before it got taxed at that period.
Right. Yep.
And dump it in there. And the narrative goes, hey, you save this, you don't take the tax hit now while you're earning the high level of income.
Yeah.
And then you wait until you get to retirement, and then your tax rate will be lower.
I have heard that saying,
right?
Yes.
You heard that? I'm going to tell you the reality of what I generally see is that doesn't happen.
Oh, really?
Yes.
Oh, wow. Okay, I didn't know that. So explain. Tell us more.
So I feel a little bad, because that narrative has been going on for decades, and I would say it's changing now, because now plans offer something called a Roth 401k, where you get taxed now, and then when you take it out in the future, it's not taxed again in theory, right?
Okay, yeah.
I don't know if they'll ever change tax code on that, but at any rate, that right now that's what we know.
Yeah.
Those are becoming a lot more prevalent in retirement plans now, versus when you got your first job at 22 years old or whatever it was, and you started saving pre-tax. Those are a lot more prevalent and available options now. But the one thing that retirees sometimes get surprised by is, hey, my income tax rate is still really high relative to what I thought it would be.
And so, why is that?
Well, sometimes it's because they had good behavior. They saved a bunch of money, and they have a portfolio that's...
Okay, so they're in trouble even that they did the right thing.
That's right. Or they built up a really big retirement account because they just did the discipline over a long period of time, and they have more money than they thought they would have that they have to take out.
Okay.
So sometimes there's that. The other thing is, especially in the US right now, it's, the focus is on lower tax rates, but at some point, you hear the narrative of how are we going to pay for this deficit? Like, how are we going to start closing that gap? And our tax rate's going to go up. And so that could always be the lingering surprise out there in the future. But really to come back to it, capital gains taxes, to think about those, think about your what your expectations for tax rates are, because they may not be different than when you were working at this point. So,
okay.
But the things to think about, let me hit on capital gains a little bit. They're good in a way. Like, I know I might get some listeners here that are like, I hate paying taxes, and I get that. Like, it's painful. It's like you see your money just leave. But sometimes when you need money out of your portfolio, if it's done really well and you've made money, you have a liability there if you need to take it out. And if you're going to need to spend the money, you're going to have to recognize, hey, I made money on this that's now subject to tax. And so if you need a big chunk out of your portfolio, figuring out how you can take that out efficiently is sometimes a good thing to think about.
Okay, and maybe talk a little bit more about what you mean by that, like the liability, how does that offset? Like, tell us a little bit more about what that means and what that looks like for clients.
So let's just use a round number. If somebody comes to me and says, I need $50,000 out of my portfolio, and they want to maintain the balance that it has today, and the portfolio is doubled in size, meaning half of it's taxable, half of it's unrealized gain.
Okay.
If they kept it just very simple, to get that $50,000, half of that essentially would be capital gains. So $25,000 would be subject to capital gains taxes. So if they need $50,000 absolute, because that's what the bill is coming due,
right,
they're going to need to take more than that out of the portfolio if they don't have the cash to pay the taxes.
Okay, got it.
And so sometimes they're like, oh, I only took $50,000, and then I got to April and they're telling me that I owe $7,000 in taxes on it. And it's like, how'd that happen? Well, you had a $25,000 realized capital gain to get that dollar amount out of your portfolio.
Okay, so that's something that you strategize with, like you're looking at how to minimize that.
And one way one thing that often goes unlooked is if you have a portfolio of a lot of different things, sometimes certain things in your portfolio won't perform in short periods of time. Maybe you bought it at a certain price and it went down, but you still like the investment.
Okay.
Like, it's just a temporary period. There's some things people can do now to take action for potentially a future tax, capital gain tax. And what I mean by that is, let's say they buy an investment, they like it, they think it's a good long-term hold, it just goes through a rough period.
Right.
And they look at their account and they're like, okay, I bought it for that, and it's below that. I still like the investment, so I'm going to hold it. Well, as a taxable investor, what you could say to yourself is, hey, what if I sold that, book the loss? I can essentially carry that forward for my lifetime until I need to use it up. They can sell the investment, sit out of it for 30 days, or buy something equivalent to that at the same time, so they're not out of the investment. But just sell the investment, book the loss, and don't feel like, oh my God, I sold it at a loss. I can't. I booked the loss. I'm never going to get it back. The reality is if you sell the investment, sit out of it for 30 days, and go back into it, you essentially remove the wash sale period that the IRS has on it, where what you can't do, because I know you're giving me that look. You're like,
I'm like, you're getting real technical for me there, Brian.
I can see the look. So sometimes people go, okay, I'm going to just sell that, book the loss, and I'll buy it back the same day. That mitigates the whole benefit. They don't let you take the loss on your tax return.
Okay.
Until you can, it'll just keep getting deferred. But if you do sell it and you sit out of it for 30 days and then you go back into it, completely fine. You get to keep the loss, whether that's offsetting a future capital gain or reducing your income. Like right now, you can reduce your income up to $3,000 a year with losses, but no more than that. What we generally would like to do is try to pick off things that may have dropped throughout the year, because you own a lot of different things, right? You should have
you're diversified. That's what we've been talking about.
Right. So you could eventually start to plan years in advance for trying to book some of those losses and get back into those investments appropriately.
So what are some things that you would look to plan for in advance?
So if somebody's coming to retirement, they're like, we're going to start selling, we're going to have to do a little bit of a projection, right? We're going to have to assume there's going to be a certain amount of growth. we can start talking to them about ways to start booking those losses if they exist. Not all the time does that opportunity present itself, but certain market years like 2020 where you have these big drawdowns, or 2022 where you have these big drawdowns, my guess is there's a lot of opportunity in those periods to do some tax planning without altering your investment strategy. And getting those things built up so you have a bank of those losses, if you will. You're still invested, you'll recover, but being able to use those when you actually do hit the point where you're going to have to sell down the portfolio.
And again, that's planning for the retirement, since we're talking about how to plan for taxes in retirement.
Right.
Okay.
The other is on pre-tax money. So like think of retirement plan assets. If you firmly do get to the point where you believe you're not in a lower tax rate, like you're not going to be in a lower tax rate, because there are ways you can start.
Are there reasons why people don't end up in? I think you said before, it's just because they saved well, and so now they're.
Yeah, if they're lucky, they end up with this big taxable portfolio, right? That's the more of the capital gain. But let's say it's producing dividend income and interest income and stuff like that. But the portfolio may be so big now that it's producing a large taxable income number every year that they didn't expect.
Got it.
So their income's like higher in retirement because it's continuing to push out income and it's continuing to grow, so it kind of compounds over time. But then they get to a point in retirement where they have to start drawing down their retirement assets, and that's ordinary income. So there are ways you can start doing conversions, meaning you start taking money out of that retirement plan and converting it to a Roth. So
maybe talk about that a little bit. Like I know that's there's a strategy that we use. Like talk about a Roth conversion. I think that's a hot topic too.
Right. So one way, and I'll keep it simple because we could delve into this in really big detail for like a whole episode. But
we like to keep it simple.
We'll keep
it
simple.
That's good.
So it's essentially taking money out from your pre-tax retirement account at the base level and converting it, meaning transferring it over directly to a Roth 401k or a Roth IRA. You do a conversion. So you're basically saying, tax me this year on the amount that I take out. Put it over into another tax deferred retirement vehicle that won't get taxed again. And that's just a simple metric, but you might look at it and go, I have all this huge chunk of money, and if I do a conversion on the whole thing, it's a huge tax bill. You don't have to do that. You can do little chunks along the way and just do it over a long period of time. And
can you just do it once a year, twice a year? How often are you allowed to do it?
The reality is you can do it throughout the year. But you just want to watch how much gross, like how much you actually do, and not lose track of that. So a lot of the time, like what's palatable to people is, oh, I'm willing to pay a little bit. Like I'll budget for that. I'm willing to do a little bit now. Do another chunk next year, and it's usually
It's like a multi-year strategy.
Typically, it's done once a year, just because they know it's coming versus trying to do it multiple times a year. Because the income tax is all one calendar year, so if you do it once, it's the same as doing it a bunch of times. There's that aspect, and tax gets kind of complicated. There's a lot of strategies out there that people forget get taxed differently. So, for example, if your portfolio has some bonds in it, depending on what those types of bonds are, if they're taxable bonds, like corporate, you lend money to corporate companies, that interest income is taxed just like your income's taxed. So it's interest income, just like you get on your savings account, it's taxed at the same rate. Other things in their portfolio, if they're in things like legacy mutual funds and things like that, where they're pooled with other investors, there might be some turnover of the underlying investments there that push out capital gains forcefully every year. And a lot of the time that surprises people because some things will just go for like 4 or 5 years with no tax liability. And then all of a sudden the fund has this major shift in strategy and they realize a bunch of gains under the hood. And they push them out to all their individual investors, and the investors get it right literally in December usually. Like no time to plan, and they're sitting there like, wait, what happened? So there's ways to do that, and a lot of the time people get stuck in those vehicles because there's an unrealized gain. They don't want to get taxed on it. There are a lot more efficient vehicles now out there in the marketplace to not have that happen. So things like exchange traded funds, or separately managed accounts where you own the individual securities directly, not through a fund,
Okay.
that you can be a bit more tax efficient with. But I don't always tell people, like sometimes like I know that paying taxes is painful, like everybody gets surprised, but if you can kind of do check-ins throughout the year and say, okay, where are we at with the realized gains? Where are we at with the income? What does it look like for the rest of the year? They can almost emotionally start to plan for that tax event a little bit better than waiting, like doing what most people do, which is they wait until April if they're filing on time, or May, June, July if they're filing extensions. And then they wake up and they're like, oh my God, the return came. And I have to write a check. So,
well, that's obviously we hear from a lot of different types of prospects and clients. And it's always like the big question I feel like we always hear is, how do I minimize my taxes? But maybe you're saying like, just plan a little bit for it and understand it a little bit better.
And I will say sometimes like what we see is the tax worry is greater than the investment worry. So instead of saying what's a good investment, is it going to grow my money over time, they come to it first and say, like, I hate taxes. I don't want to have any tax events out of it. And that makes it very difficult to choose strategies if the tax tail is wagging the dog, the investment dog, if you will, right? So sometimes you have to just be careful. Like if you're making money, most of the time you're going to owe some level of tax. You can defer it and try to plan around it, but and the only way to really avoid capital gains tax at the end of the day is to die.
Oh,
right.
I wasn't expecting that.
Right? If you're not going to take the money out, you're not going to sell anything. The only way to really avoid it is you die, and under current law, it's that goes on to your next gen or whoever inherits it. And gets,
well, that sounds like a whole other
that's
topic.
That's a whole other topic. But, it's almost like death and taxes are the two guarantees we can talk about.
Yeah.
All other things, if we say guarantee, get cut out. So,
yeah.
But there's vehicles like that, but there's ways to defer. It's just you're never really going to get away from it to where it's tax free, and that's the thing.
So that's how taxes are involved in investing. Your favorite,
right? to pull it back, because there's certain things depending on where a client's tax situation is. There's certain things that you probably might not invest in their taxable account if they're primarily worried about paying income tax every single year. And you might put those types of investments over into tax-deferred accounts like IRAs or something like that. And then there's other strategies you don't want to use, like, and I won't say this broadly, but you don't want to use certain vehicles that might just create these surprises in December for people that you can't plan around because they come so late in the year. Those vehicles you might not be able to use in a taxable account. So Kelli, what else do you want to know about taxes?
I have nothing else prepared for taxes. I'm the marketing person, remember?
So maybe a story about planning around taxes, like how it works, or...
Oh, I don't know. That sounds a little technical still.
So there's sometimes we always talk about the unknowns. Like, it's easy to do planning if you have all the certainty in the world.
Right.
But there's always the unknowns.
Yeah.
So,
which we know never happens.
Right.
It's
So I always go back to this one, because this is usually where people get the biggest surprise, because it's usually their biggest asset.
Okay.
Their home.
Okay.
Right? So a lot of the time people buy and live in a home for a long period of time. They might do some improvements to it, but if we've looked
some people do that, yes.
Yeah, some people do. But a lot of the time when you're looking to move, people end up, like, they want to downsize, or they want to do something else, or they just, kids are out in a different area of the country, or they just want to go have a different experience.
Yeah.
The one thing that usually gets people is when they sell their home, they could have, depending on how much they sell it over what they bought it for, they could have a pretty big tax surprise all in 1 year. So sometimes what you can do is, if you can figure out, plan in advance, we think we're going to do this.
Like, how many years in advance are we talking here?
Probably a year.
Oh, so a year of planning before you're going to sell your house might help you minimize taxes a little bit.
And even more advanced notice. So like when people say, hey, like they're talking about dreams and goals and all that.
Yeah.
Hey, we think in 5 years, like this is way too much for us. And
or it has stairs, or they'd have to do all these
yeah.
improvements to stay.
Yeah.
I think the big one you just touched on too is the grandparents. Like a lot of kids are moving away and they want to be near their grandchildren.
They want to be able to buy a house, not know.
Well, that and they want to be near their grandchildren on the other flip side. So.
Oh, I meant the kids. The kids are like, the market my parents live in is way too expensive. I'm going to go.
That's very true.
Go somewhere else. But yeah, that's usually the one that I see the biggest impact. Usually is the home sale, and it's if you can give. Like usually you can pick up on that in their like dreams and stuff like that when they're talking about their goals. But if they start talking about that, that's usually a good opportunity to start figuring out, are there strategies out there that can help mitigate that? But the more time you have to plan, the better.
So optimal time, is there an optimal time? Is it 10 years? Is it 5 years?
I wish there was an optimal time for everything.
It depends, right?
Yeah, my famous quote, it depends, because like, what if like 5 years ago you said, let's say you lived in Florida, for example, not you, but the royal you. Let's say you lived in Florida and you moved there, and 5 years ago you start saying, hey, you know, and I want to move into like a different part of the country. Like my kids don't come visit. They're too far away. It's too hard for them to travel.
Too expensive for them to travel.
Too expensive. Yeah, that kind of thing. So you want to leave Florida and sell your home. When I say it depends, like in this current market, it might be hard for you to just sell your home quickly. Like people got so used to that. Like I could sell my house in a week and it didn't sit. If they said in 2025, I'm going to sell my house and that's what we're sticking to, they might find themselves in a position where the house sits a lot longer, or they're having to cut the price to come down. So I always say there's no like ideal time, because you're not going to be able to time the market. Ideally, you would want to do it when everybody is like, there's a big pool of buyers, you can move quickly, you can get the best price, but that doesn't always happen. And you might not be able to wait. Right. So you're going to sit around for 5 more years and wait for this to recover, hopefully, or not. So, so sometimes
life is short. So sometimes you just want to do what you want to do.
That's right. Sometimes you just get over the tax problem and you just do it.
Yeah.
But I can't say
we are human, remember?
That's right. That's right. I don't think there's ever really an opportunity, let me step back. I don't think you can always time that up, like a big sale like that, perfectly, unless you have like it planned out well in advance and you really know the market well. But sometimes people get to that point and they're like, it's time for us to go, and it's like not the ideal time to sell. We don't know when that's going to come back.
Yeah. So
there's those things that are not, that's where the it depends comes from. The other thing that we see is typically like business sales. So those, hopefully you can time, right? But not always. So imagine if you've known people who've sold their business that they built up from the ground, and sometimes an offer just comes along that's just too good for them to try to wait for the perfect tax year to do it.
Yeah, that's true.
And sometimes they're like, hey, I have to eat this a little bit. Because I don't know if something like that's going to come along anytime soon or again in the future. So sometimes you just have to pay the tax, as I would say. Otherwise, you might miss a bigger opportunity if that's the only thing you're focused on. So, but business owners have that challenge because they can't really always perfectly time, like, I'm going to get this thing closed on January 1st this year. It might come.
We're going to wrap it in a bow.
Yeah. The deal might only be on the table for 3 weeks in November, and you don't have the time to wait another 5 weeks to get to the new calendar.
So some planning around, selling a home, selling a business, some big asset can go a long way. I think is the point.
That's right. You can try to keep as much of it as you can. If you have advance notice, but it doesn't always work that way, right?
Yeah.
So surprises come along.
Yes. So we talked a lot about tax, and obviously tax is a huge topic, and we have so much more to probably say about it and talk about. But I think that's it for today. If you are interested in learning more about our firm, check out halberthargrove.com. Also, subscribe to our YouTube channel because we will be doing more discussion on tax, and we don't want you to miss it. Brian, anything else from you?
Nope.
Thanks for coming to Fearless Money Talks.